The stock market frequently serves as a gauge of public sentiment and can have an impact on gross domestic product, GDP. The output of all products and services in an economy is measured by the GDP. Economic sentiment fluctuates along with the ups and downs in the stock market. Although the stock market can have both good and negative influences on GDP, people's spending ultimately drives GDP growth as sentiment changes. In today's video, we will learn about how the stock market affects GDP. At Finance Doc, we will be sharing more explanation videos related to cryptocurrencies, trading, forex, and many more. So watch this video till the end and hit the subscribe button. And click on the bell icon to get notifications for our future videos. So let's begin the video. How the stock market affects GDP. We must first examine what propels economic growth in order to ascertain how the markets affect GDP. Spending and investment are the main drivers of the GDP of the U.S. economy. GDP is frequently represented as a percentage growth rate from one time period to the next. For instance, if the quarter-to-quarter growth rate is 2%, the annualized growth rate for the U.S. economy in that quarter was 2%. Here are a few of the important factors that contribute to GDP. The U.S. GDP is mostly driven by consumer spending. Spending by businesses involves hiring, investing in new technologies, purchasing new machinery and equipment, and constructing new offices and factories. Exports are purchases made by domestic businesses from clients abroad. Building roads, bridges, and providing subsidies to various businesses, such as agriculture, are examples of government spending. Together, all of the aforementioned can be impacted by investors through the stock market, either badly or constructively. How bull markets affect GDP. When equity markets are increasing, we are in a bull market. The stock market largely has an impact on consumer confidence and financial conditions, which in turn affect GDP. Bull markets, in which stock prices are rising, are characterized by a large level of optimism about both the economy and the future prospects of different stocks. Companies can utilize the money they raise by issuing new shares of stock to expand their operations, fund new initiatives, and hire more personnel. These activities all increase GDP. Since there is strong demand for stocks, it is simpler for businesses to issue new shares during a bull market. These same businesses can also raise additional capital by borrowing from banks or issuing new debt, known as bonds. If GDP is increasing, that is a sign that the economy is doing well. Investors buy the bonds, and the money is used for GDP-boosting corporate growth and expansion. Investors and consumers are wealthier and more upbeat about prospects for the future as a result of growing stock prices. Improved spending as a result of this increased confidence may result in significant acquisitions like homes and cars. As a result, businesses experience increased sales and profits, which further boosts GDP. How bear markets affect GDP. A bear market, which occurs when the stock market is down, results in dropping stock values and may be unfavorable to sentiment. Investors hurry to sell stocks during a bear market in order to protect their investment from losses. Typically, the losses result in a decrease in consumer expenditure, especially if a recession is also being feared. 2 consecutive quarters of negative or contracting GDP growth are frequently used to identify recessions. When consumers start to cut back on their purchases, it can damage businesses' sales and income. Companies are consequently pressured to reduce expenses and staff. An increase in unemployment and more future uncertainty worsen the decline in consumer expenditure. Additionally, finding new sources of funding for firms may prove tricky, and managing existing debt may become more onerous as income declines. All of these elements contribute to a decline in consumer and company confidence, which results in less stock market investment. The declining investment and spending brought on by diminished confidence ultimately have a negative effect on GDP. Special considerations. Less is spoken about how the stock market affects GDP than how GDP affects the stock market. Corporate profits rise in response to rising GDP, which is positive for stocks. The stock market affects GDP and the economy overall, albeit indirectly, whether there is a bull market or bear market. The inverse happens when GDP declines, which results in less spending by businesses and consumers, which pushes the markets lower. Thank you for watching this video. If you like this video, don't forget to hit the like button and subscribe to the channel so that you don't miss out on our upcoming videos.